Hey guys, Doug the Retirement Guy here. We got a review of the REX AI Equity Premium Income ETF, AIPI. Is this good for a retirement account or not? The dividend shows a 38.01%, so it gets a lot of interest. So let's take a look at how well REX is actually doing in a regular ETF fund. First off, the AIPI REX Equity. This is a fund that really dives into the AI, the artificial intelligence companies. So they really have gone in and came out and picked up a lot of different companies that are all in that AI. So they have the best of the best, and they're really trying to generate income by writing covered calls on its holdings. This thing launched in June 4th of 2024, and we get to see you know some time of what's happened here because we're basically about a year into this. How well have they done? Where are they going with it? And see where it's at. We show a 34.8% distribution rate. The expense fees was very impressive at 0.65 for a REX fund, and their SEC is negative 0.27%. When we look at their holdings, and you can really look at this and you see all the major players in AI right now, they are invested in, and they're not just cherry picking as if everything goes into NVIDIA or the supercomputers. They've really spread this out equally across the platform. A lot of money invested into these things and really getting into the actual funds themselves. So I was right impressed with the holdings that they've had so far. So why AIPI? Well, I know everyone's going to say, well, it's the 34% return from the dividends and the interest and everything that you get from it. I'm actually on a little bit different page of this. I do like the 34%, don't get me wrong. I do like that. But I think the next one is the enhanced exposure that there seeks to amplify the returns of the AI leaders. To me, this is the more important one. I have not found a fund yet that is not so widespread that they've gone out and picked every AI player in the market and have not just made a little entry point into it. They've made some decent numbers of dollars invested in stocks and so on that I'm really impressed with what they've done. That I believe that you have a great exposure of AI, of the AI funds, is going to generate the returns that you're going to see. And I think you're going to see some natural growth from this as well as this market just explodes. And you don't have to guess, is it going to be NVIDIA that's going to take off? Is it going to be AMD that's going to be the leader? You have them all in this package. So no matter what, you have the first, the second, the third place leaders of AI. That's what I think makes this a very, very strong, um, interesting piece to be involved into. The powerful combination of the potential growth of the stock or the fund and the monthly income, because this one is a monthly paying dividend. And like we've always said, is monthly payers, you can either take the regular cash flow like we like in retirement. I would like to have that. Or you can turn around and reinvest your potential into buying more shares of either AIPI or something else, but reinvesting your investments and multiplying it. So looking at AIPI 1 year on the calendar, so they're about, like I said, about 1 year old. Um, well, just a hair over 1 years old. Started off around that $55 price point. Had a rocky road from its start. Kind of found its own little path, and really got hit with the March Madness and then the tariffs. Tariffs tore this one dramatically up, and you can see right there in April it took a huge nosedive, and it's been trying to recover ever since. So when we look at this, you can see it finally has come out of the basement. It's slowly climbing the hill, trying to get back into the run. 1 month out, they're at 1.79% positive. 6 months, they're still down 10.91. Year to date, they're down 11.34. 1 year out, they're down 21.99. So their first year running, they're down 21%. You do the math at 55, every starting point is always the highest that they normally do, and you always come down from there. The 2-year mark, you got to remember, we're into the second year. So basically, we are 13 months into this as we speak, and it's giving you a total of negative 16.63%. So this thing's kind of found its own natural bottom. It's kind of found its own natural spot, and it's starting to recover slowly into this. It wasn't what I was expecting when I first started looking at this. I looked at that big 34% return. I figured AI, we're going to be strong across the board. But because they are spread so far across, the positives I thought, some things have affected it worse in other areas. And then, of course, the tariffs have kicked in and the March Madness. And we're seeing this as a downward trend and now coming back. So I think, again, it's one of these possible potentials that we could say, yeah, it looks bad, but we can put some money into it to start making money as we go down the street. The return over the past 30 days is what I started looking at this a little closer. And you can see where it came in 30 days ago at just below the $43 price point. And even with this being such a smaller narrow, so everything looks bigger. So you can take from the first arrow to the second arrow, it was only $1 difference between the two, and it looks huge. But it got back up to the $44 range, couldn't hold it, dropped back down, and now we're at the 47 or 43.77 point, can't hold that. So it really tells me that this thing is running more and more towards its natural average. So if you look at the 1 day, it's down, quarter of a percentage point. 5 days, it's basically up 0.82%. 30 days up 1.7. The 30-day average is 42.74, and the 90-day average is 41.40. The trailing low is 41.10. So that basically tells you that if this thing drops, it's not going to go below 41.10 unless something major happens like the tariff program accordingly. But natural low base is going to be 41.10. So this puts us in a number of where do you want to be? How do you want to play it? The charts will tell you. I think we'll get to the next screen. We'll get you better information on where we would say to play this game. But you can see it's a rocky road. It's got its ups, its downs. It's not very smooth across the board. The dividends. Well, this one here, you can see we've taken it back as far as we can, which is all the way basically one year out. And it had a very solid, $1.45, $1.50 range until it hit that May point where they dropped it way off, but it's coming back up. And you see the average dividends right now are $1.38 per share per month, which is a decent number coming out on a monthly basis. So dividends could help make a big change with helping with our losses, or our NAV loss can help down the road. But for an income package, $1.38 per share per month, that's a fairly hefty number. It's a decent number coming back. So what we did here is we showed you that if we put $10,000 into AIPI back in July of last year, so we backed it up 12 months, it was at $55.94. We would have been able to buy 178 shares. We also collected $1.48 in dividend payments. And if you look down the dividend payments, they've been holding it at that dollar plus range. $1.20, $1.30 right now. Like we said, the average was I believe $1.37, $1.38, which is solid. But here's the problem. The stock value has lost. We have lost 21.77%, or $2,176 of our initial investment of our starting value. That's huge. When you look into dividends that we've gained, which is a 29.52% total dividend gain, which is $2,962, this is really over 12 months only given us a 7.85% gain total, or $785 over 12 months. So at this point, I'm not very impressed with a 12-month package of where it's at. Because we bought in early, the numbers dropped off. The question is, if you bought at the right times, if you bought continuously, or bought when you feel that we now know a natural bottom, where would this one play into? So we changed the computer demographics a little bit, and we come in and said, look, we know that the rock bottom was 41. We saw that in March, so we threw $40.68 into it. We were able to buy additional shares, 245 shares. We hit that the April tariffs, so it kicked it down again, but it recovered back up. And you can see over the past 5 months, we are actually at a positive 7.6% gain, or $759. The dividends continued on, that we're getting a 12% dividend of $1,201 over those 5 months. So we actually have a positive of 19.61% so far for 5 months. This is what we talk about when we say buying and understanding a stock, of where to buy and where to get in and where to get out. And this is what it's told us, that if we know our bottom is at 41.10, we can jump into a stock. If you look at everything on the board, 41.10 is right where the magic number for this fund is really at, to make money at it. Because with that, we have three funds above that and 2 funds below that. So this is where I would say this fund now is probably a spot where you can start playing and start gaining and not losing your NAV value if you buy just a little bit each month, every month, to stay on top of it. So is AIPI a time to buy? We believe it is. We put it on there everything under $43, we believe is a fair and easy number to play with. Your 90-day average is 41.50. Your 30-day average is 42.74. So we're really playing in that 30-day average and below. And basically, I'm going to say, with the trailing low of 41.10, I don't expect it to get below that 41.10 price point, and the current price of 43.62. So I would be a person to say, if this thing would just take a little bit, 1%, 2%, maybe a 3% drop to be comfortable to say, hey, let's throw some money into it. And we always say, you never put more than 5% of your entire portfolio into any one particular account. You want to make sure that you do this equally, fairly, and that way you spread the funds across your entire portfolio, and so you never get hurt. So is AIP good for a retirement account? I think it is, if you buy right. And when I say that, I wouldn't just jump in this one when it first was introduced. You want to buy it right. You want to understand this. The dividend looks great at 29.62% for 12 months. But remember, you lost 21.77% over those same 12 months. So we go back and say you're only a 7% gain if you bought at the wrong time. But if you buy in that target range, it'll reduce what you're looking at, and your total investment really puts it into place. So AIPI, I think, is a long-term play. I think this is something that will take a long period of time. I mean, I'm not talking 1 year. I'm talking a long run, 2, 3, 4 years, to really get the benefits out of it. But I think once they get it rolling, get it happening, with AI taking a little bit longer to do, I think you'll end up seeing that this is a long play that will pay nice dividends on a regular basis, especially if you buy at that right period of time. And if you see it drop below, keep adding to your base. We'll follow back around on this one and just make sure that our numbers are exactly what the computer is putting out and telling us where we're at, to make sure this is safe for everyone. Guys, this is Doug the Retirement Guy. I hope you like what we're doing. If you're not a subscriber, hit that subscribe button and leave any comments what you think about AIPI as a long-term hold. Everything helps the channel grow, and we are helping to grow your pocketbook, and we'll catch you at the next video.